At Professional Insurance Strategies, we specialize in helping businesses like yours take the guesswork out of insurance. Today, let's talk about performance bonds. A performance bond is a financial instrument that helps ensure the successful completion of a large project in areas like road construction or real estate development. Well, what is a performance bond? A performance bond is issued by one party to contract the other party as a guarantee against the issuing party's failure to meet the obligations under the contract or to deliver on a level of performance specified in the agreement. Performance bonds are typically provided by a financial institution such as a bank or an insurance company. The bond will be paid for by the party providing the services under the agreement. Performance bonds are common in industries like construction and real estate development. A performance bond may also be issued for some commodities transactions. The performance bond in that case is to ensure that the commodity being sold is actually available and will be delivered if the buyer indeed wants to take delivery. There are three parties to a performance bond. The principal is the primary entity or person who will be doing the work. Often this is a contractor or similar type of firm. The obligee is the customer, so to speak. It is the company, individual, or government entity who will be the recipient of the work. A city who will be having road work done by a contractor might have a performance bond to make sure the work is finished to specifications. The surety is the financial institution providing the performance bond. A performance bond is not insurance. If there is a claim against the bond by the obligee, the surety will pay the amount of the bond to the obligee, but they will look to the principal to make good on the amount paid out. Performance bonds are only given to financially stable firms. When applying for a performance bond, the surety will require information from the contractor such as at least 2 years worth of financial statements prepared or reviewed by a CPA. They will also look for a copy of the contract that the performance bond is tied to. They will also need an application with the surety bond. They might need real estate or other collateral that is owned by the contractor. Overall, the surety will want to ensure that the principal of the bond is financially stable. Again, a performance bond is not insurance. In the event the contractor does not complete the work, the surety may either cover the cost of hiring a new contractor to complete the project or provide compensation to the obligee to allow them to use the money to complete the project as they deem fit. What are the benefits and drawbacks of a performance bond? Well, a performance bond has both benefits and drawbacks. Benefits of using a performance bond can include the obligee is assured that the project will be completed even if the principal can't or won't meet their performance obligations. Next, the obligee will not be out additional funds to get the work completed. There are some potential drawbacks that can be associated with performance bond as well. The surety may try to claim that the obligee did not comply with all the terms and conditions detailed in the bond in order to avoid paying some or all of the amount of the bond. The surety may try to get the obligee to settle on a lesser amount or less expensive remedy to the principal's underperformance under the contract. Depending upon the terms of the performance bond, it will be up to the obligee to quantify the financial losses they've suffered based on the principal's total or partial failure to perform under the terms of the contract. If the obligee initially underestimates the cost of the principal's underperformance and they incur a greater cost to complete the project than initially thought, they may not be able to recover these additional costs from the surety. How much do performance bonds cost? The cost of the performance bond can vary greatly, but in general, it tends to be 1% of the total contract. On larger contracts in excess of $1 million, the cost might go to 1.5% or 2% of the total value of the contract. Every surety's terms will be a bit different. The creditworthiness and financial strength of the principal will also be a factor in the ultimate cost. Thanks for taking the time to watch our video and to learn about performance bonds. Remember, we specialize in helping businesses like yours take the guesswork out of insurance.